I have a 4-step financial analysis workflow that I do for every real estate syndication that I look at. Now, having an actual formal process is critical, and understanding financial analysis is the backbone. It's the only thing that's going to make you truly successful as a real estate syndicator or a real estate fund manager. So I hope you find this useful. I used to have a training program about 2 or 3 years ago. It was called Altitude, and Altitude, that's why it's called the Altitude 4-Step Financial Analysis. This is still the same analysis that I use today on every deal that I look at. So it all starts with, as we talked about last week, it starts with these basic facts and assumptions. We talked about last week how there is a range and how in the very beginning of your analysis, it starts very, very fact-based with a little bit of assumptions-based, and then it changes, though, from there. It starts getting, as time goes on, and as we go from just needing NOI to getting a pro forma or a 5-year cash flow, we start getting more and more assumptions. And so there are some assumptions that we make along the whole process, and we'll see that go on. But we also have assumptions that we determine at the very beginning. So after we determine what our basic facts and our assumptions are, we then go through and figure out what our NOI is and our potential value. And I say potential value because there is a big assumption there in determining value. We're applying a cap rate of a market cap rate. This property hasn't been appraised. It's just what we think it would go for. And so there we go. So after we've determined our NOI and our potential value, let me get this out of the way. All right, after we've determined our NOI and our potential value, we then are looking at cash flow. And so here again is getting a lot more assumption based. And then finally, after we've determined what the cash flow looks like, we have performance. So these are the 4 steps. Under performance, I consider that not only how is the property potentially doing, what are those projections about return, but I also look at it as how would it perform as a syndication? How do those measures line up? So performance is really tied into not only just the regular, what's the IRR potentiality of the property, but also those measures on, is this even a good investment for us to look at? So under these, each of these has, we'll choose a different pen color. Actually, I need to move this again. So let me do that again. So we're going to do this in blue. So now in each of these are different, what we call different pieces of the puzzle that go underneath them all. So under here, obviously, if we're talking about basic facts and assumptions, we've got facts. Oh, that's. We've got facts. We've got assumptions. We have market data. Under And so those are the key things that go into that main step. Now, under the next step, the NOI and potential value, here we've got rent roll, which also feeds into income, and we have operating expenses. Now, that's not surprising because these are what comes up in our NOI calculation. Under cash flow, we have things like debt. We have capital expenses. Actually, I think I'm going to call them other expenses. We have reserves. And interestingly, we have taxes. Now, taxes isn't really something we consider very much on the when we're doing a syndication, but it is important to know what the after-tax cash flow is as well, just because you may still need it for whatever your other purposes are. If you have somebody who's actually going to be buying it free and clear, things like that, it's useful to know. And it fits in just fine on our cash flow because all of those same things also feed into our discussion of, all the things that are taxed also feed into our discussion on whether or not it is a good, how the performance is. And so in performance that we consider a few other things. We consider the purchase and the sale. We consider the equity. And then we consider measures. And so these parts all go to our 4-step program. Now, there are at almost every level, I'm going to move this again. I think we'll just erase that. All right. There are at almost every level, actually, oops. There are at almost every level, and the most important thing out of this that I'm trying to get across is there are different levers that move each of the main functions. So there are a series of levers that come from NOI that change our NOI and our potential value. Green. So these are the NOI levers. We have our income amounts, and that's rent roll, things like that. And a lot of those things start off as facts, right? So whatever the income is the income, or so you think, but we also have some things that adjust income, like whether or not we're choosing to do pass-throughs and whether or not we'd be able to pass through everything that we're thinking of, what we're using for a vacancy factor, what we're using for a credit factor, things like that. So I put it as a broad idea just to start thinking about income is certainly a big lever, and expenses is obviously a big lever. And on expenses, I am specifically not saying that it is that we can change what we consider an operating expenses, because operating expenses are pretty objective. It's pretty standard on what we consider an operating expense. But what we choose to use as our measure for it has some assumptions built into it. There is other income. There is your vacancy, as I said, your credit risk. We've got your pass-throughs, got management, And certainly, if you are doing management yourself, how much you charge for the management is certainly a lever that you could change the entire NOI with, which flows all the way down to basically what the return that your investors would be getting. So there are also coming out of this same box, there's also levers for your potential value, right? And there, I mean, we've got our NOI, we've got our price, and we've got our cap rate. I mean, that because price equals NOI over cap rate. So any of those things can adjust, obviously, what that potential value is. Out of cash flow, there are also major levers. And what you'll notice here, so our first big one is NOI. NOI changes our cash flow. So these things feed up into themselves. So every single one of the levers that is within NOI is within cash flow. And you'll see as we go on, every one of the levers that's in cash flow also has an effect on performance. But some of the measures in cash flow do not have a downward effect. So they're not affecting things within NOI. So under this, we've got, for example, debt. Whether or not we change debt has absolutely no difference on NOI. It doesn't change it one bit. And so it is not a lever of NOI, but it sure is a lever on the amount of cash flow. We also have our CapEx. We've got our asset management fees. Comes out of cash flow. It's a discretionary spend, but it's coming out of that cash flow. So it is a lever that can change, and it can change everything else. It changes our cash flow, and it ultimately changes the return for investors. We've got our how much we are going to keep in reserves or how we're going to build up reserves. What assumptions we use for growth. And what is our hold period? Actually, let's change hold period up the level. So these are the main levers as it relates to, there we go, as it relates to cash flow. Now, performance has its own levers, obviously. So here we've got, just like we talked about, we have our cash flow. It comes up, and because it comes up, we also have NOI is also a lever. We have the price we're willing to pay, and then the projected sales price. We have sales fees. We have our purchase and syndication fees. We have waterfalls. We have hold periods. And to some extent, we have what our discount rate is. All right, so here is why we're talking about this now. When we're doing financial analysis and ultimately underwriting, we're putting together a package that we can show potential investors of what we're expecting it to, how we're expecting it to perform. By understanding the different levers that take place within that process, financial analysis and or underwriting, the more we understand those levers, the more we can tune it to being an asset that will work in order for investors to be interested at all. It's also important to kind of get how it all goes together like this, because when you're having those conversations, and if you're dealing with a more sophisticated investor, it's much easier when you've got the framework in your head about what this looks like to switch gears, and know what they're talking about and be able to get it back to really addressing what their question is, or if they have a particular issue, or they just want to know why you're doing something the way you're doing it. If you have the model in your head, it really makes sense. And that's also why we're talking about underwriting and financial analysis at all in this program, because theoretically you could just take, the simple thing off of the sales brochure that you're getting, then and use that for your underwriting and figure out, okay, well, we're going to be making this much money, and just kind of hope that everything works out. But if you have all these things in mind, now you can have real conversations with investors about how everything works. And then you can also fine tune it as it's going and make determinations. Maybe you've decided, well, I don't think our reserves is high enough, but how is that going to affect everything else? Well, it's going to, if I need to increase my reserves, that means I have less cash flow, which means that ultimately the timing of my distributions is going to get thrown off, which means that I will need to let my investors know, hey, look, the overall return for this period isn't going to be what we thought it would be, because we really want to build up those reserves. So you can be having those kind of conversations when you get the model, and you can make changes on the fly. So let's go to, let me ask if there's questions yet. Alejandro, do you have a question? Any questions so far? Oh, okay, perfect. Let me know if you do. All right, so let's switch to this spreadsheet. All right, so here, and this might look a little familiar, this is the CCIM underwriting workbook. And I chose to start here rather than using what we were using 2 videos ago, or 1 video ago as well, because a lot of people will be more familiar with these sheets. I've actually added some stuff into these sheets to make it a little bit more useful. And I think it will give a little bit of a basis of why, of where everything goes and how it fits together when you see a different model. And then you can see how what I'm talking about feeds into that. So let's go ahead and get started. And I've put these in order as well. So of the 4 steps. So this is step 1, right? This is of facts and assumptions. So these are the assumptions that are taking place within the in their 5-year analysis workbook. The facts are actually more built on the NOI page than anywhere else. But I think it makes a little bit more sense to separate them out. So you'll see when we look at the 4-step tool that we use, the spreadsheet, it actually breaks it apart into all the different parts, just to make it a little bit more clear. And so here's our assumptions. So ordinary income tax rate, capital gains tax rates, straight line on recapture is at 25. This is actually at 20 as of today. And these are here because they're part of CCIM's analysis. CCIM really focuses on the investor side and helping investors make good decisions, whereas what we talk about really is more on the syndication side. We will go through the taxes probably next week, just because it is something that you do need to know. And why not? We're using it in the same sheets because we can, and it doesn't take much more work. So here's the other assumptions. What is the vacancy rate going to be of your property? How does rent escalate? So year 1, year 2, year 3, year 4. So right now we have it in 3% annual bumps. Other income is escalating at 3% a year. In what we're going to be using today, we're not going to be using another income. Actually, no, we will be using another income. So it escalates at 3% a year, and expenses escalates at 3% a year. So in what we're talking about, actually, the other income that we're talking about is going to be pass-throughs. So it's good that those match. Cap rate used in the sale. I think those are a little bit too broad. So let's bring them a little bit down. Let's say our alternative is 6.5, and 7. And our expense of sale, I would say, let's keep it at 6%. That means 3% per side. Actually, let's do 6.25. That will cover our escrow and title fees as well. All right, so here is, let me clear that. Okay, so lease analysis now is the next topic that we're talking about. And I decided rather than just go right to the rent roll, this is a good time to actually talk about lease analysis. So let's go ahead and put it in the right step category that we have. So this here, we are talking about the NOI and potential value step. So let's say this is the name of the building is 123 Main. Our first tenant is Joe's Store. They are in Suite 101. And then this is, I like to have a lease abstracts for every single property I do, every tenant. And so this really has everything that you would need. Now, it has some of the things like right at the top you need to know. Obviously, a tenant is very important to know right at the top, because when you're sorting through them, that's how you're going to sort through them. All right. Date of lease is the date the lease was signed. The term is how many years it is. The rent is whatever that rent is. The expiration date is that. So let's say this is June 1, 2021. Say 5-year term. And we'll deal with rent later. And then this would be May 31st, 2026. Let's say it is a 2,500 square foot building. And we are, how many parking spaces they've been allocated. I'm assuming this is going to be just a 2-unit building. And so we'll just leave that blank. Term in months, 60. So you can put the security deposit, the renewal options. You want to fill this out completely when you're doing your full analysis anyway, because then you've at least got it in one very nice, easy to see area. And this section over here where we've got the paragraph number, that is for exactly where it is in the lease. So premises is often in paragraph 1.1. Permitted use is oftentimes in paragraph 4.1. Square footage is often in 1.1. Parking is like in 1.4, I think. Term is in, normally it's in 2. And this is just from, from having done this. Security deposit, I think, is in 3, but I don't remember. And renewal options is oftentimes like in maybe 4.5 or so. And now we've got a rental period. So let's say we've got in year 1. So let's say 6/1/2021. And then it is, say, through 5/31/2022. So dollars per month, let's say that they are at $5,000 per month, which means that they are also in, put that out, $60,000 per year, $2 a square foot. And then we can figure out what escalations are going to be. But I just wanted to quickly go, how we do this, and you'll see why in a minute. It has a lot of other great ideas for, putting in who pays for what and operating expenses. These are things that are very, very valuable to know where the different parts of a lease are. Looks like I left in some from a previous use. So you can see like the subordination clauses in paragraph 20, the estoppel letters in paragraph 21. Those are all where they normally lie anyway. So there's our first one. We've got Joe's store. So let's do one more quick one. We've already filled that in. So let's say this is Bob's restaurant. And so let's say, just for fun, that they started at the same time and they're both on 5-year leases. So premises is in suite 102. Square footage is, let's put him at 3,500 square feet. So fairly good sized restaurant. And so he's starting in there. We'll put him at 6/1. Oops. And let's put him at a very different dollar amount. Let's say he starts at $8,000 per month, and now we've got him paying $96,000 per year. Now this all feeds into our rent roll, which is also still part of the NOI and potential value, right? So we've got this is the monthly rent. This is the annual rent. We've got Joe's store, Bob's store. Obviously, we've got a 6,000 square foot building. So we've now identified the main parts of our rent roll for the purposes of NOI and potential value. Now, this will change as we have escalations built in, and it'll have what pass-throughs are really coming in. But let's say that that our pass-through amount is that we get. Let's say it is $1 a square. We'll say it's $12 a square foot in CAMs. Times 5,000. I mean, times 2,500. And then he is paying $12 a square foot also. All right, so now we have other income as 3,600. So now let's look at the NOI sheet. Now this is the full sheet that is coming from CCIM, and I've just referred to a few things in here. So what we've got is how we look at income. So the way that we start looking at income is that all that money that's contracted for is rent that is contractual. It's likely to occur. So we are basically counting on it. So that's the potential rent that you can get in this period right now. Now, we also count vacancies that we think are going to happen as well, but you want to make sure to then reduce the amount for vacancies back out in this vacancy and credit losses. So don't make it less than what the actual dollar amount is. You want it to be higher. So here we're using just a rough, so our potential rent income is that 156,000. We are using a 7% figure because that came from here. That came from this assumption. We changed that, our vacancy and credits risk to say 5% because we don't really have any vacancy. And then suddenly now we're using 5%. That's a much lower figure. So that leaves us with an effective rental income. Now here is a big lever, right? So this is a lever. Because how we change that obviously changes this dollar amount. Now, if let's put it back at 7. Oops. Okay, so let's put it back at 7 just for fun. And then we'll see that now, it's 145,080 versus where we just changed it to, oops, wrong sheet, to 148,200. So obviously it's going to change that amount of your income. And since NOI is your income minus your operating expenses, it's levering the entire equation. It's changing all those numbers. And so it's clearly just a lever to keep in mind. So let's go ahead and come up with a few other, let me erase this. Oops. Clear. Oops. Nope, I would rather that. That way, got nice room. All right. So let's go ahead and finish out the discussion of our NOI calculation. Because the purpose here is now we've got that first snapshot that we're talking about. All we're trying to do is really get that big facts and then little assumptions. And that this part right here, that's your little assumption. That's going to be changing. So we've now got our income. Now we need to reduce our our taxes. And so we can put these in by there, but I've already said that we've got a large amount of, let's see, we've got 12,000, or we've got $12 a square foot times 6,000. So we've already gotten 72,000. Oops, this didn't add back in. Let me put that in because this is our other income amount. So our other income is the pass-throughs in these two leases. That is there. And then it also is, and I actually would rather put it in so it gets reduced by vacancy and credit loss. For whatever reason, CCIM didn't do it that way. Our spreadsheet does have it, so it reduces that amount. Because there's really two types of income. You've got your pass-through income, which should be counted, and you've got your other income, which doesn't. So let's just put in hard code in that $72,000 of operating expenses, and now we've got left with $148,200. Interestingly, that is the same amount as our effective gross rental income. So let's say we find this property at a 6 cap. This is a property that we actually already know. We think that the purchase price is going to be that 2280. So this is a 6.5 cap. So now we've got our purchase price, and now we've got not only the NOI, but we've gotten the potential value. Now this is, I'm sure, review, but the main point of why we're going through it right now is to see that here is a lever. So this is what changes everything in there. Also a lever in here is this other income, what our pass-throughs are. Because even though we've got an area in our lease that has these the operating expenses and who pays for what, a lot of times, probably, I don't know, you've all seen it 20% of the time, 25% of the time, you'll have a landlord who's not really passing through expenses the way they can. Some of your bigger operators definitely will, but your small time operators tend to get lazy, don't do increases, and don't do pass-throughs really the way they're supposed to. And so that has a direct effect on ultimately what you collect. So your income changes, and then, but we make assumptions when we're purchasing the property on whether or not the landlord's going to throw a tissy when we try and collect those. And they do, and it can become a problem. But it's an assumption that you're making that ultimately is a lever on the whole thing. So under the CCIM sheets, we have, is it under this? So let's say, we'll just leave that like that. Now, they also use different measures for here. So let's say so we'll talk a little bit about cash flow, because here we're at a new, a whole new level, right? So this is the third step, and this is the cash flow step. So now we're at the third step of the 4-step analysis. I think it's a little bit confusing the way that CCIM has decided to build it out, just for other people and for really kind of seeing where those levers are. Oops, get my mouse back. So let's put in the first huge lever that we come to here is we are looking at the amount of our loan. So let's say we lever it at 65% loan, which is 148,200. Say our interest rate is 4%. Our amortization period is 25 years. Our loan term is, it doesn't really matter for this purpose, but we'll just say it's 10. And our payments per year is 12, so that's all normal. So now we've got our normal debt service built into here. And so now, and I hope we have a positive cash flow. Okay, good, we do. So now we've got a nice positive cash flow. Just erase that. We've got a nice positive cash flow. Now we've got built into our cash flow, we've still got these levers. And there isn't a considerable amount of work to do in the way they underwrite the sheet. But let's look at the levers specifically. So we've got the debt portion, right? I mean, here's a big lever. So how we're going to be doing debt is a big lever, and that becomes a whole different topic of conversation. So we'll talk about that more next week, about debt and how that works on here, because ultimately it's such a big lever, and it will change everything about how your underwriting goes, to buy that property and to really fund it with syndication, it becomes very critical. Not that there's others. So, and everything comes forward, right? So, like we talked about before, we've got our net operating income is a major lever. So that changes, and then everything else changes in the cash flow. And so part of one of those levers too was, somehow I lost my thing, is this was a lever that we had from NOI, as was vacancy and credit loss. So those are levers. Now we've got our interest is our lever. We're not going to go through participation payments or cost recovery. It's not important for what we're doing. So our amortization, the other things are leasing commissions, right? If you're going to need to lease the property out, that's a below the line cost that's going to be affecting you. We also have our capital expenses. Now here, oops, because we're still in the taxable income calculation. Oops, and then that throws everything off that I've just done there. All right, so we have our leasing commissions is one. Our funded reserves is one. Remember, we talked about that. We've got our, I would have put capital expenses here as an actual thing. So let's just change this. That's a lever. There's a lot of levers that go into this part, into the cash flow statement. And each of them changes everything that we're doing in terms of where we get. All right, does that make sense? Are you getting the topic of levers? Give me a nice yes or no. Alejandro, Christian.
Yes.
Yes, okay, good. So ultimately then that leads us to the topic of our sales. And for those who came in late, the reason that we're going through this, we'll go back over it again in the beginning just to finish up. But we're going through the 4-step financial analysis. The last step is the performance step. And this is what your investors actually care about more than anything else. So we've got our cash flows, what it would look like, what a potential sale looks like. Nothing new or exceedingly interesting. Again, taxes isn't really relevant to what the conversation of syndication. It is part of your sheets as well, just because it should be, and just so that you have that information. And so you can use it on just investment property sales, or you could use it, so you can use it in brokerage, or you can use it in syndication. And now here you've got ultimately your IRR returns. So you sell it at your nice middle, your before tax is a 15% return, which is pretty good. So for this sample property, we've got a nice, reasonable return for our investors over a 5-year hold period. Now, again, we have levers in here. So all of those things that took place here in cash flow and so our debt, because this was part of cash flow, is a lever, right? We changed that. It automatically is a major lever. Our sales price is a lever. And a lot of these, I mean, you don't know what it's going to sell for in 5 years, but we have to make assumptions. So this is one of the bigger assumptions that we have to make. So it should be a reasonable assumption and supported by evidence. But then we have our cost of sale. And this is your broker fees, right? So this is the amount of money that you maybe are taking as a brokerage commission for half of the deal. So in this simple transaction, you're making, over $80,000 for the sale of the property. I say 80 because that's half of 165, splitting it out both. It's a very bad idea to double lend a deal when you are acting as the seller. So that's why it's half of that. And then ultimately we've got, the hold period is 5 years. And so we have a nice, reasonable return as our result. And all of it was affected by all of those levers. So let me switch back to where we started. So all of these levers are now have all added up to giving us, an IRR of 15%. But if you change any one of these things, you're suddenly going to have a change in that 15%. I mean, not really the potential value. This is there more for brokerage than for than specifically for what we're underwriting for here, but nevertheless. But if we had changed the vacancy credit risk, our IRR would change. We make the credit risk or vacancy percentage we're using much higher. We're suddenly going to have that 15.02 fall down below 15. If you change how you are going to be getting that your pass-throughs recovered, that's going to also, if you think, well, I'm not going to be able to recover it all, then you're going to need to drop that down. In your cash flow, if you decide to do an asset management fee, which these sheets don't use, that's going to reduce the amount. If you decide, okay, I need to put more to reserves, that's going to reduce the amount. So all of those things change ultimately this return that your investor is looking for. So when you come to the end of your analysis, what you want to have is to have a nice sheet that's well supported by a really well done financial analysis that says, okay, this is what we're projecting and this is why. And you've balanced out to optimize it as much as possible. You've tweaked the amount of asset management versus property management versus how much debt we're going to take versus all those things to hit that target, this 15% that you are striving for. So that 15% is the goal because you've already identified through your fit that the risk tolerance level for your investors is 15%. Now, actually, I made up the numbers completely as we were going, and it just worked out perfectly to be 15%. So that was great. But that was purely by accident. It was. I know. I definitely deserve a lot of kudos for that. I hope you found the 4-step financial analysis process to be useful to you. Feel free to give me a call if you need help setting up a real estate syndication, a real estate fund, or you're looking to raise money for your business, or you're looking to, you're a developer and you need additional capital. We're the people to call when you're doing a Regulation D Rule 506B or 506C offering.